You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, investor attention was a little split this week between companies reporting earnings, many of which topped expectations, news of rising consumer confidence, modestly positive data on durable goods orders and the housing market, and third quarter GDP numbers. But they also kept an eye peeled for varied forecasts for the next round of Fed easing to stimulate the economy, which is widely expected to be announced next week. Overall, a mixed week for stocks, materials, and industrials were on the move. Financials remained in focus, and it was reported on Friday morning that the economy grew at 2% in the third quarter. Let's bring Steve Reitmeister, our editor-at-large, back in here now to go over some things with us, mainly about earnings season.
Yeah.
It's shaping up to be a good earnings season. All in all.
Yeah, well, we're pretty much through the harder earnings season, so we can already pretty much put a report card on this, which would be an excellent showing for corporate earnings.
Okay.
But because we kind of rallied up into the reports, you're seeing a lot of buy on rumors, sell on news kind of activity. So even though companies are reporting very well, quite a few people are taking profits on that news. But don't take that as a bad sign. It's just because we rallied up 10%
right
into these reports. So very strong earnings season.
Okay, and one thing I have noticed about this earnings season, unlike a few others in the recent past, is that some good old-fashioned sales growth has been reported.
Right. So for the last few quarters, everyone's talking about that almost all the profits were coming from cost cutting, which was increasing margins and things of that nature. But where's the sales? And I think this quarter we did get that. So most companies did report higher revenues than were expected, which helped generate higher than expected earnings. And yeah, this is getting back to good old-fashioned earnings the way it's supposed to be, with the top line coming in at a healthier clip. Yeah.
So because there were a lot of companies reporting earnings above expectation, does that mean there were a lot of estimate revisions?
Yeah. The estimate revision ratio for the past week is about 1.48 positive revisions to every negative revision. Or put it another way, about 60% of companies are seeing estimates going up, 40% going down. That is a very healthy dispersion, and means that in general corporate earnings are going higher, which generally leads to higher stock prices.
And for those who may not yet know, even though if they've been watching here for a while, we have talked about it in the past, earnings estimate revisions again are what?
Yeah, well, we all know what the consensus estimate is. So when we come into earnings season, we say, oh, the company beat the consensus, which is the average of what the stock analysts say for the stock. So an estimate revision is when they revise it either higher or lower. Obviously, when analysts take a look at the earnings from a company and say, you know what, I think things are looking better in the future, and they revise it upwards, that's a positive revision, generally lead to higher stock prices. We don't want to see those negative revisions, though.
And you've always noted that these earnings estimate revisions and taking note of them is an essential part of a successful investment plan. Give us a little weekend wisdom on the main reasons that investors should be using this data in their investment strategy.
Right. Let's just put it this way. Earnings is the most fundamental form of investing, because when we're buying shares in companies, we're buying an ownership stake. Okay, so earnings are very important. But it's not just the earnings growth, which people get messed up with. They think that the companies with the highest earnings growth will generate the highest stock returns. It's not true. It's the companies that beat their earnings expectations or beat their earnings growth rates, which is more important, which is where earnings estimates come from. When a company beats their earnings expectation, estimates go higher, and it's a leading indication of a company that is having the strongest form of momentum and that was most likely going to repeat this process and keep exceeding people's expectations in the future. So that is why I'm just a big proponent of following the earnings estimate revisions, because it tells you the companies that are beating what people are expecting, which is going to bring the investor, the investors are going to chase it with their dollars.
Pretty accurate indicator.
Very accurate indicator. There's only a few anomalies out there, like things that really have stood up the test of time to show that you can beat the market. Earnings estimates, I believe, is the strongest of all of them.
Is it the most sound?
There's nothing that's 100% foolproof, okay? Because when we're talking about estimates, we're talking about human beings
Right.
making predictions about what will happen in the future. But the human beings who are doing it are stock analysts who are highly trained individuals who have very good insight into what's going on in the companies and the industry trends and macroeconomics and so on and so forth. And so it's the best bet we have. So it's kind of like going to the casino and putting the odds in your favor, okay? So, red and black might be 50-50. Okay, well, green comes up every now and then. But it's really skewing things in your favor where maybe it's going to come in your favor 55, 60% of the time, which is a nice advantage over what's generally like in the stock market.
All right, quickly, on your radar for the week ahead.
It's all going to be about jobs next week. So we have ADP on Wednesday, leading up to the October employment situation on Friday. So definitely that's where the focus will be.
Okay, and we will see you back at the roundtable just a little bit from now.
Sure.
Stay with us. We want you to hang in there because there's more still ahead here on Profit from the Pros that you won't want to miss. Here is your Bull and Bears Stock of the Week. Internet search giant and an agricultural company top this week's Bull and Bear of the Week. Joining me now, Shiraz Mian, our research director, to fill in the blanks detail-wise. So I guess everybody by now might have guessed that the search company that we're talking about is Google.
That's right.
The Class A shares, GOOG is the ticker symbol on the NASDAQ. I can understand why this one is a bull. They're getting into everything.
That's right.
Including cars and real estate.
That's right. There were a number of fears and clouds hanging over Google. China was an issue. There was increased competitive pressures, margin outlook. And they came out this quarter and they just blew all those fears out of the water, I want to say.
Yeah.
Extremely good outlook. Their dominant position in the search space has never been in doubt. In fact, when people talk about search, they say, have you Googled it? So it's
right.
The name is synonymous now with online search, but that's not the only thing. There are a number of things and a number of applications and a number of business areas, some near-term, some long-term, that are expected to keep driving the company's growth momentum. The search advertising is the core revenue earner for the company. Okay. Advertising outlook is improving, particularly the online version of it more. The offline advertising is moving to the online. Yep. And they have a strong presence in that, which comes next to the search results. But they also have a good prospect and outlook in the banner ads. They are a relatively small player, surprise, surprise, in that category, behind Yahoo and Microsoft. And then they also stand in a long-term basis to benefit from the growth of their mobile operating platform, the Android operating system. Mm-hmm. In fact, that operating system, in a handful of years, has become a dominant operating system and is gaining market share for the more established players. So overall, a very strong platform for this search giant, which should help it sustain its growth momentum for quite some time.
Okay. Monsanto, MON, the ticker symbol, is the underperformer in the crowd this week. Why?
It is, again, both of the stocks that we picked this week are the leaders in their particular space. Monsanto is also a leader in the agricultural products, the herbicides. The negative thing in their story is that they are less of a dominant player now than they were in the past. A key negative is their inability to deal with their herbicide business. Roundup was a major product for them. They lost the patent on that in 2000, and generic brands entered that space ever since. And then in 2009, the supply of competing products for that product was so heavy that they had to address it, and they addressed it by bringing down pricing. This product and this business, which at one stage accounted for a third of its revenue, is now basically a drag on the overall company. So they haven't really addressed the competitive negativity and problem that they encountered in the herbicide business. They have issues on the seeds business as well, and that's why it's a negative.
Okay, we have more stock talk for you. Still ahead, stay with us. And now, Stock Talk, analysis of stocks in the news. Well, shares of Sony Corporation shot up about 3% earlier this week on unconfirmed rumors that Apple was eyeing the company as a takeover target. So we thought it was worth taking a look at the Japanese electronics maker on that news, and here to do that with us is equity strategists Tracy Reinick and Mike Vodicka once again. And we should note that the data that we're going to be talking about regarding Sony is prior to their upcoming earnings announcement, which is set for October the 29th. So all of the data, revenues, and all of that is pre-earnings announcement. So with that in mind, is there anything that you see, either of you, that is a red flag here that may point or suggest that Sony should be a takeover target?
No, not really. They're massive. You forget how big a company they really are. I think part of the reason that the Apple rumor got started is because of the big, powerful brand. I mean, Apple has a powerful brand, but so does Sony. And we're reminded of that this week when the company announced that they were retiring the Walkman, which came out in 1979. And actually, they're retiring it in Japan, but they are going to continue to manufacture it in China, apparently. But they've sold 400 million of those Walkmans. About half were the actual original cassette player, and now they've kind of changed the brand to be CD players and MP3 files and things like that.
Well, it didn't help also when Steve Jobs at Apple said recently, we got this pile of money sitting here, but we'd like to keep some powder dry.
Right, and people put two and two together because of the Sony brand recognition, and it's a similar type of feel to the Apple brand recognition. I mean, people will buy a Sony product just because of the name.
Right.
So you have kind of that kind of interesting thing going on, but again, they're massive, and it would cost a lot to buy them out, and they've kind of been in a restructuring mode themselves. So maybe that's what makes some people think they might be a takeover target. They actually lost money last year. They should be profitable this year, but they've been having troubles in the TV area. They are starting to put out some new products like the Sony Reader, which is their e-book, which to compete against Kindle and the iPad. And then there's rumors that there's going to be a PlayStation phone, possibly as early as next year. So they're going into that area. So, they have some things going, but they're in kind of this restructuring mode too.
Mike, what are you seeing?
Well, the longer-term trend is most definitely bearish with Sony. We have a 10-year chart on display right now, and you can see shares have steadily been declining for that time.
Really?
Absolutely, yeah. They haven't really cashed in on the big consumer electronics boom that we've seen over the last couple of years. But moving into a shorter-term interval, what we see is shares of Sony have actually performed pretty well for about the last 2 months, beginning in September. Shares are up about 21%, so they've easily outperformed the S&P 500. Are those gains related to the rumors of the Apple acquisition? Probably, most likely. I would think so, absolutely. So the short-term momentum is fairly strong right now, but the longer-term trend is still questionable.
So the longer-term bearish trend for the company, you think, is still in place?
I do, yes, yeah. We're looking at some overhead resistance at 35 and then also at 40.5.
That's interesting. And where are they at in their range, in their trading range?
Well, right now they're at $34, so they're about to bump into some overhead resistance, and the multi-year high is $40.50. So that's within striking distance here. So it'll probably put some pressure on shares.
It's going to be interesting to see. The only thing that would really make any sense to me, anyway, and to a lot of people probably, is if Apple wanted to try to cash in on the games part of Sony's business. But I guess we'll just have to wait and see how that plays out. And if it plays out any differently, of course, we will be back with an update on Sony, SNE, the ticker symbol on the stock. More still ahead. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. GDP numbers, QE2, and of course bond ratings. They all kind of go together, and that's what we're talking about here at the Roundtable this week with our editor-at-large, Steve Reitmeister, our research director, Shiraz Mian, and equity strategist, Tracy Reinick. So, Shiraz, I'm going to start with you. We, Friday morning, got the report for GDP for the third quarter, the first pass, shows growth of 2%, kind of what the street was looking for on the consensus. Well, on the surface, what do you think? Is this a positive?
I think it is. It's a shade lighter than what the street was expecting. The consensus was for 2.1. It came at 2.
Okay.
But overall, most of the moving pieces, if you go inside the report, were as expected. The consumer spending number edged up a little bit from the Q2, Q1 numbers. Housing is a little bit down. We were expecting that after the expiration of the tax credit. Capital expenditures are a little bit down, but still positive. And the trade drag was less than we had seen in the second quarter. So 2%, the market should be okay with it. Because the overall framework that they were kind of pricing in, that it's weak and it's not strong enough, that the Fed would continue to come in and do its further stimulus, the QE2 that you referred to. So that move from the Fed side still remains in place. And in that respect, the overall picture for the economy remains the same.
Okay, Tracy, this report showed a little bit of a pickup in spending, as Shiraz mentioned, for consumers. Is the consumer starting to come back here? Is that what we're seeing? At least, is that what you're seeing?
Yeah, it seems like it. I was encouraged by the consumer side, actually, and I have been kind of a bear on that for a while. But, I mean, we're hearing that from some of the retailers. We heard from Coach this week, and they're seeing kind of a big build going into this holiday season, and they're seeing real demand. So I do think the shoppers are going to be out this Christmas, and I do think it's going to be a better than we've seen holiday season for a while, and that's going to actually, I think, help to boost confidence overall.
Some of the retailers, the larger ones anyway, are increasing the personnel that they're bringing on hand for the holiday season as well, so another good sign there.
Yep.
Steve, as far as QE2 is concerned, does this GDP report this morning maybe chip away at the need for more monetary easing going forward?
I think it chips away at the need, but that doesn't mean the Fed is going to stop. And they've put, their whole parade of Fed governors out there in the public, and they made it very clear what they intend to do. And so I think they find it very hard to pull back from that. So maybe they just do a little bit less of it than they said. But what I find here to be most interesting is that when the Fed first started talking about QE2, that rates went down. People saw that lowered the dollar and sparked up a conversation about inflation. So if there's going to be inflation in the future, then it starts to make bond rates go up, which is the opposite of what QE2 is supposed to do. So there's actually a little bit of a fight going on between what the Fed is trying to do, lower rates, and what that means as far as higher inflation, that rates would go higher. So it's a very interesting dynamic going on.
Shiraz, the street looking for, in the announcement next week that's anticipated on QE2, street's looking for a program to range between $500 billion and $1 trillion worth of Treasury purchases. But we had a journal article come out during the past week that kind of threw a little bit of a monkey wrench into that. And so now that got investors and traders a little skittish. What do you think about that?
I think the surprise element is the only remaining variable about the QE2, as Steve was referring to, the whole parade of the Fed officials coming out and continuing to talk about the idea of quantitative easing and further bond purchases is pretty much baked in the cake in the market. The issue is how much, and that's what you are referring to. My personal sense is that the Fed is not going to do what they did, the shock and awe thing that they did in the end of 2008. They would like to maintain some level of flexibility, so I wouldn't be surprised if they come out with some number, but the number being that we will do about $500 billion over the next 2-3 quarters, and then reassess what effect it has on inflation expectations, on bond yields that Steve referred to. So that is the size and the duration of it are the remaining sticking points. But my sense is that it's going to be smaller, more episodic, and more flexible from the Fed side than what we had seen on the QE1 back in the dark days of 2008.
And Tracy, if the package is smaller than anticipated, larger than anticipated, how's that going to impact stocks?
I think some people are already worried about it being smaller, so I think we're kind of starting to see that kind of priced in the smaller side. If they actually do go more of the shock and awe, I actually think it might help the stock market here and to bust out of this trading range that we're in. Okay. But I think they're going to wimp out. I kind of agree with Shiraz that we're going to see it on the smaller side.
Okay, quickly, bond rates, are they bottoming?
I think so. In fact, when we get to our stock picks of the week, I think you'll find out exactly what I think about
Okay,
that.
well, let's go right into that then. Okay. So kind of dovetails.
Yeah, I'm going for the ultra short 20-year treasuries, which is basically saying that if the rates start going up from their current historic lows, that this fund will appreciate quite greatly. And I think whether you take a look at it from the standpoint that after 30 years of rates going down, it's time for them to go back up, or if you are a technical investor and you take a look at the charts, that it is broken above the 50-day moving average for the first time in the entire year, I believe the timing is right to be shorting the bonds.
All right, Shiraz, top stock pick, quickly.
A far more spicier pick than what Steve was talking about. Chipotle Mexican Grill. Okay. They have about 1,000 outlets in the country. They're planning to increase that in the low double digits. They had an awesome Q3. About 11% in comp sales. They beat both on the top line and the bottom line. I think the earnings outlook is extremely good for this burrito shop.
All right, Tracy.
Johnson Controls, which is a big play on China. You know, I always come down here with something with Asia. Right. And they saw revenue up 74% in Asia just this last quarter, and they're going to build about 13 million car batteries in the next 3 years there, and they see 30 million by 2015. So it's really a huge growth story on the automotive side in China and the rest of the developing countries.
Interesting. All right, we're going to keep our eyes peeled in the week ahead for developments in QE2 and jobs, as Steve brought up earlier in the program. And we will hope that the week ahead is a profitable one for you. Since it's Halloween week, let me be among the first to say, boo. See you next time on Profit from the Pros.